In this video, I'm going to be going over my secret techniques on how I avoid consolidating markets. Now, why would you want to avoid sideways markets in the first place? Well, there's actually a lot of reasons. For one, sideways markets are really hard to trade in.
Wow, I hate this.
They are extremely unpredictable because there's not a clear trend, and most of the time, it's hard to identify a clear entry or exit, at least a good one for that matter. So if you do end up entering into a choppy market, you'll most likely enter at the wrong time, resulting in you losing the trade.
Well, this sucks.
There's also the risk of getting into a trade in the first place. Because of the lack of clear direction, traders may be tempted to hold onto a position for too long, way longer than they actually should. So that's not good either. And on top of that, there's the performance of trading indicators. If you've ever used a buy-sell indicator, like mine for example, sorry, just clearing my throat, you will instantly see the indicator performs so much better and it's way more accurate when the market is in a trend. Compared to when the market is moving sideways, the indicator starts performing not as good. So you get my point. Consolidating markets are pretty shitty and you should avoid them like the plague. But how do you avoid consolidating markets in the first place? Is there even a strategy to identify them? Are there any secrets? Well, yes, there's a couple. And lucky for you, I'm gonna share them in this video. Let's not waste any time, let's get straight into it. Okay, where do we start? Now, I have a lot of techniques on how I personally avoid choppy markets. Some of them are more subjective, some of them are objective, and some of them are just plain simple little tricks. With that said, some of the techniques are better than others. So this is how we're gonna format this video. We're gonna start off with the little tricks that I have first, then as we move on throughout the video, we'll get more and more advanced with the techniques, resulting in the last trick, which is my all-time favorite and which is what I use basically every day. So that's the format. Sound good? Well, you don't really have a say, so I'm gonna do it anyway. So to start us off, we're gonna start really simple. So simple, I bet you've overlooked this strategy. But before that, I have to ask you a question.
Are you a day trader?
Or do you need your trades to execute
Faster?
I'm sure we've all been through this. You see a trade you want to enter. So you go to your broker and click buy. But then your broker takes forever to execute and doesn't execute the trade for another 5 or 10 seconds. During that 5 seconds, the chart collapsed. So you ended up losing a ton of money. This can be extremely frustrating. Lightspeed is a premier broker that allows active traders to take advantage of the opportunities the market presents, meaning they have extremely fast execution times, which if you're a day trader, you really need them. They have competitive commission pricing, awesome customer service, and a cutting-edge trading platform. If you haven't heard of them and want to take your trading to the next level, you have to check them out. Now, when talking to Lightspeed about this promo, I told them I want to help my viewers. So I got them to give you a crazy ass deal. If you use the link in my description, you will receive 3 free months of their trading platform, which is like the equivalent of a free $390. You also receive 50% off commissions if you use the code TradingLab. Like, that's an insane deal. Go check them out. They are an absolutely awesome company. I love them. Now, let's go back to the simple strategy I was talking about before. The strategy includes the 200 EMA. Now, you might be thinking,
how the hell do you use a 200 EMA to avoid choppy markets?
well, let me explain. First, add an exponential moving average to your chart and change the length to 200. So far, so good. Now, this is one of the most subjective strategies, meaning it's more so how you perceive the chart personally. In other words, there's not really a direct answer. But with that said, it can still be an extremely useful strategy. So the first way to use it is by looking at the slope of the line. Yeah, that concept you learned in 4th grade math class that you thought you'd never use, well, here we are. So what I mean by using the slope is looking at the steepness of the line. If the EMA is making very gradual movements, and for the most part, the line is moving sideways like this, then you're in a consolidating market, and you should avoid taking trades during this time. But then if you compare it to say a trend like this, you can see the 200 EMA is making very steep movements, and it's pretty easy to tell when it is. So you would start looking for trades during this time. Now, Now, I want to make this clear. None of these strategies or tips are entry signals. They are just areas where you should look for entry signals. Hopefully that makes sense. So you can use the slope of the EMA to identify consolidating markets. Steep lines, good. Sideways lines with little gradual movement, bad. Another way you can use the 200 EMA is by looking at the distance between it and the price. For example, you can see here price is very close to the EMA and is sticking around it a lot, almost kind of like the EMA is a magnet. If price is staying around the EMA a lot, it's a consolidating market and you want to avoid it. Compare that to a chart like this. Here you can see price is very far away from the line, almost like it's repelled away from it. This can indicate the chart is trending. So those are some questions you can ask yourself. Is price sticking around the EMA or is it being repelled? Like I said, more subjective, it's kind of based on how you're perceiving it, but a good trick nonetheless, so I thought I'd share it. Another quick subjective tip is by using support and resistance areas. So what you would do is just go on a higher time frame like the 1 hour or daily and draw your areas of support and resistance where price got rejected a lot. You'll often see that price makes big movements when it first breaks and reaches a new level of support or resistance, like this, meaning it'll be trending a lot more when it first breaks into these new areas. But if it's between a major support and resistance for a while, it's gonna be consolidating a lot more. Like I said, more subjective, but I had to go over it. Now we have our next tip, and this is when things start getting a little more interesting, because now we're gonna start entering the realm of objective strategies, meaning there are specific rules you need to follow with these set strategies. Our first one involves the ADX indicator, or the average direction index. You can use this indicator to help you identify when the market is ranging. How you would do this is pretty simple actually. If the line value is below 25, that means the market is probably consolidating and there's not a lot of momentum. If the line is above 25, that means the chart is gaining momentum and it's starting to trend. Pretty simple, right? So here you can see the ADX value is below the 25 mark for a while. And if you look at the chart above, it was actually consolidating the whole time the line value was below the 25 mark. But if we move here, the ADX value was above the 25 mark for a long period of time. And if we look at the chart, price was moving a lot and trending, making it easier to predict the movement. I really like this indicator. I don't use it all the time, but it can be used every now and then if you want a quick little hint to see the momentum of the market. Pretty useful. Now we're gonna get into the really juicy part. This is my final tip, and I actually use this strategy all the time when I personally trade. Now, I really didn't want to plug my own indicator for this video, but I feel like I would almost be lying to you if I didn't add this strategy to this video, because I literally use this tool all the time when I trade, and it works extremely well for me, so I had to add it. This is how you would use it. This really works well with a buy-sell indicator, at least if you have a good one. So in reality, you can use this with any buy-sell indicator. It doesn't even necessarily have to be mine. You can use it in correlation with any indicator you want. I mean, heck, you can even use this tactic with price action strategies or even smart money concept strategies. But for this example, we'll use my indicator for the signals. So one of the major drawbacks of using buy-sell indicators is that sometimes it'll give you signals to enter when the market is consolidating. And as we discussed earlier, markets that are consolidating are extremely hard to predict. So a lot of the time the indicator will give a signal to buy or sell, and it'll end up being a false signal, resulting in a losing trade, which nobody likes. So basically, indicators are a lot less accurate when the market is moving sideways. This is how you fix that. For my private indicator, I added what is called the trend table, which is actually really cool because it gives you all the information you could possibly want, including if the market is consolidated. Now, the cool thing about this is that the trend table is based off of actual numbers. So it's either yes or no. It's not subjective to where one person sees it one way and another person can see it the other way. There's only one answer, and it's based off of actual numbers and math. So that's why I really like using this. So it's pretty simple. This is how you would use it. So what you would do is just check the table if it says the market is consolidating or not. If it says it's consolidating, you do not take any buy or sell signal. signals, even if whatever indicator you're using gives you one. This includes even any trades in general if you're just using price action strategies or smart money concept strategies. But if the table says it's trending upwards, then you can start to follow the buy signals. If it's trending downwards, you can start to follow the short signals. Simple enough, right? I also want to make this clear. If you do follow this strategy, you're going to get way less entry signals because for the majority of the time, the market is consolidating or moving sideways. For the most part, the market trends for a very short period of time. So just know that you'll get less signals, but they'll be more accurate. So here's an example. The indicator gave us a buy signal, but if we look at the trend table, it says the market is consolidating. So we do not enter this trade, and good thing we didn't because it would have gave us a losing trade. But here's another example. The indicator gave us another buy signal, but this time we take a look at the trend table and it says the chart is trending upwards. So we can enter this trade, and look what happens, the price skyrockets up. There's also a lot of other metrics you can look at to see how well the market is trending. For example, you can use the trend strength. This will show you the strength of the actual trend in a percentage value. The higher the value, the stronger the trend. You can also look at volatility. Higher volatility means the price will be moving more. Lower volatility means the price will be moving less. Now, I want to make this clear. You don't have to use my indicator with this table. Maybe you have another buy sell indicator that you like. Well, this consolidation feature on the table will work just as good with that. Or maybe you're a price-based trader and only trade breakout patterns. Well, this table works extremely well for that too. I just wanted to clear that up. You can get really creative with this tool. If you're interested in the indicator, I'll leave a link in the description. So yeah, if you're having trouble winning trades consistently, it's probably because you're trading in consolidating markets. I'd recommend trying some of these tips out in this video, and it'll probably help you a lot. Thanks for watching, and I'll see you guys next time.
Thank you for watching.